The US dollar index stopped moving after a considerable rise amid the US employment figures. It has been trading sideways for almost the whole week. The greenback's reaction to the hawkish comments provided by the Fed's officials was moderate and short-lived. What's more, the U.S. unemployment claims figures did not allow the U.S. dollar index to return to this month's high. At the present, traders suppose that the likelihood of the key rate cut by the Federal Reserve in March is less than 20%. However, new week may change the market sentiment, while most Asian countries will be celebrating the new year. The United States and the United Kingdom will be getting fresh inflation data. And these figures have every chance to alter the situation in the currency market and affect major currency pairs. Macroeconomic reports could be considered a barometer of a trader's sentiment. In our video review, we will find out what reports will attract the trader's attention. You are watching a video calendar. Stay tuned. The pound sterling continues recovering against the US dollar. According to the situation in the futures market, traders expect 3 rate cuts by the Bank of England this year. Curiously, last week they anticipated 4 rate cuts. The assumption is likely to be shaped by 2 reports scheduled for release next week. On a Tuesday, all eyes will be turned to the UK employment figures. In November, the unemployment rate dropped to 3.9%. In December, the indicator may climb to 4%. If the data meets market expectations, the pound sterling will rise even more against the greenback or the euro. Notably, the report is likely to cause a short-lasting surge in volatility, as traders also this day, the euro's movement could be influenced by the economic sentiment data from the ZEF Institute. In January, the economic sentiment indicator increased by another 2.4 points and thus pointing to a positive change in economic expectations in the Eurozone's largest economy. Analysts suppose that in February the index will also signal optimism in Germany's business sector. If the predictions come true, the euro will gain in value against major currencies. The consumer price index data will provide traders with information about changes in US inflation. In December, the core CPI, which excludes prices of food and energy, surged by 3.9% on a yearly basis. Analysts suppose that the growth will limp by 3.8%. Meanwhile, the consumer price index also increased by 3.4% last month. In January, the growth may slacken to 3%. Notably, most officials who provided speeches after the FOMC meeting pinpointed that they needed more evidence of a stable inflation cooling. Thus, the anticipated reports are likely to be of great importance for the US dollar index. If the data exceeds the forecast, the first key rate cut could be postponed even more, thus supporting the greenback. New signs of a slower inflation growth will cause a decline in the US dollar index and boost the likelihood of the key rate cut by the Fed in May. Although the Bank of England is not hurrying to lower interest rates, signs of inflation slackening could change traders' expectations in the middle term. In December, the annual inflation rate surged by 4%. And now analysts suppose that the price pressure will continue mounting to 4.2% on a yearly basis. Meanwhile, lower price pressure may spur a massive sell-off of the pound sterling in favor of other major currencies. You have watched a video review of the key macroeconomic events that will take place next week, prepared by InstaForex analysts. Monitor the macroeconomic calendar and open successful trades. We wish you a good profit and see you next week.